Hey everyone, welcome back to the Deep Dive. We're here to cut through the noise and give you the information you need to make smarter decisions about your money. Today, we're tackling a question that's been generating a lot of buzz. What happens when you add crypto, like Bitcoin and Ethereum, to a traditional stock portfolio? Is it a game changer or just another fad?
Yeah, it's a hot topic for sure, and there's a lot of hype out there. That's why we're going to base this deep dive on a recent study that really dug into this question using hard data and a rigorous approach. We're going to unpack the strategies they used, break down their key findings, and connect it all back to the underlying investment theory so you can walk away with some real aha moments.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So this wasn't just some quick back-of-the-envelope calculation. This study looked at major stock market indices. Plus, they considered 12 of the most prominent cryptocurrencies like Bitcoin, Dogecoin, Cardano, Ethereum, Binance Coin, the big names. And they tracked all of this over a 5-year period from 2018 to 2023.
Exactly. And to really test the impact of adding crypto, they didn't just look at one or two portfolio examples. They took a really systematic approach, creating thousands of different portfolio combinations with varying levels of exposure to both stocks and crypto.
Okay, so walk me through that. How did they actually set up these different portfolios?
All right, so they started with 4 basic portfolio types, one with 100% stocks, and then 3 others with increasing amounts of crypto, a 90% stocks and 10% crypto mix, an 80-20 mix, and then a 70-30 mix.
Okay, so they had these 4 different levels of crypto exposure to test out.
Right. But for each of those mixes, they didn't just pick one set of assets and call it a day. They actually generated 10,000 random combinations of assets with 40 assets in each portfolio.
10,000? Wow. Why so many?
Because they wanted to eliminate any chance that their results would be skewed by just getting lucky with one particular set of assets. By creating 10,000 random portfolios for each mix, they could average out the performance and get a much more reliable picture of how each allocation strategy really worked.
So if we're looking at the 90-10 mix, that's 36 randomly selected stocks and 4 randomly selected cryptos, all pulled from those big indices and the set of 12 cryptos they were working with. And they did this 10,000 times for each of the 4 mixes.
Exactly. It's a massive amount of data, but it's what gives this study its statistical power. Now, once they had all these portfolios set up, they applied 4 different portfolio selection strategies to each one to see how they would perform. These strategies were global minimum variance, risk parity, most diversified portfolio, and the simple equally weighted approach.
Let's break those down one by one, starting with global minimum variance. What's the thinking behind that strategy?
The global minimum variance strategy is all about minimizing risk, specifically the volatility of the portfolio's returns. It's based on the classic Markowitz theory, which is like the bedrock of modern portfolio management. In this study, they focused on long-only portfolios, meaning you can only buy assets, no short selling allowed.
So it's all about finding that combination of assets that produces the smoothest ride, minimizing those ups and downs.
Exactly. Next up, we have risk parity. Now, this strategy is based on a different idea altogether. Instead of minimizing overall volatility, risk parity aims to ensure that each asset in the portfolio contributes an equal amount to the total risk.
So it's not about how much money you have in each asset, but how much risk each asset brings to the table.
Precisely. And this strategy considers all assets, not just a subset. It's really about spreading your risk evenly across the entire portfolio, which, in theory, should make it more resilient to market shocks.
Okay, that's interesting. Now, the third strategy they looked at was the most diversified portfolio, or MDP for short. What's the goal with that one?
The most diversified portfolio strategy takes diversification to another level. Instead of simply spreading your money across different assets, MDP seeks to maximize what's called the diversification ratio. This ratio essentially measures the bang for your buck in terms of diversification benefit. It's like finding those assets that zig when others zag, so you're not overly exposed to any one particular market movement.
So instead of just holding a bunch of different assets, it's about strategically selecting assets that truly behave independently of each other. It's like building a basketball team with a point guard, a center, a power forward, not just five guys who can only shoot three-pointers.
That's a great analogy. Now, the last strategy they tested was the simplest of the bunch, equally weighted, or EW. As the name suggests, this involves allocating an equal amount of capital to every asset in the portfolio. It's often used as a benchmark to see if more complex strategies can actually outperform just spreading your money evenly.
Right, so it's like the control group in an experiment. Now, they didn't just look at how these strategies performed historically, they also wanted to see how they would have worked in a real-world setting.
Absolutely. To do that, they used a technique called a rolling window approach. This involved taking 1 year of historical data, which is called the in-sample period, and using it to build a portfolio for the following month, which is the out-of-sample period. They then rolled this window forward month by month, rebalancing the portfolio every 20 trading days.
So it's like they're simulating what would have happened if you had actually been using these strategies to manage your money over those 5 years.
Exactly. And to evaluate how well each strategy performed, they used a whole suite of different metrics, not just the typical return and volatility numbers you often see.
So let's get into those metrics. What were they looking at specifically?
Okay, so naturally, they looked at the average or mean return, which tells you how much money you would have made on average. They also considered volatility, which is a measure of how much the portfolio's returns fluctuated. But then they went deeper, looking at risk-adjusted metrics like the Sharpe ratio and the Sortino ratio, which measure how much return you're getting relative to the risk you're taking.
Right. Those are really important because a high return doesn't mean much if it comes with huge swings in value.
Exactly. And the Sortino ratio is particularly interesting because it focuses specifically on downside risk. It penalizes negative volatility more heavily than positive volatility, which is more relevant to most investors who are more concerned about losses than gains.
Okay, so they're looking at average returns, volatility, and risk-adjusted returns. What else?
They also looked at measures of how bad things could get, like maximum drawdown, which is the biggest peak-to-trough decline the portfolio experienced, and the Ulcer Index, which measures both the depth and duration of losses. To assess the potential for big gains, they use the Rachev ratio, which looks at the probability of exceeding certain return thresholds.
Okay, so they covered a lot of ground in terms of measuring performance. Now let's get to the good stuff, the results. What did they find when they applied the global minimum variance strategy to these different portfolio mixes?
Well, for the global minimum variance strategy, the findings were pretty consistent across the 4 different equity markets they studied. Generally, they found a slight and often not statistically significant improvement in profitability when they added a small amount of crypto to the portfolios.
So maybe a little bit more return, but nothing to write home about.
Yeah, pretty much. But the really interesting thing was that even when they allowed for a larger allocation to crypto, the global minimum variance strategy almost always gave crypto a very low weighting, typically around 2–3% of the total portfolio.
That's surprising. You'd think a strategy designed to minimize risk would love the potential upside of crypto.
You might think so, but remember, this strategy is laser-focused on minimizing volatility. And crypto is, well, famously volatile. So even with the potential for higher returns, the global minimum variance strategy just couldn't stomach the added risk that crypto brought to the table.
Makes sense. So for the super risk-averse investor, adding a tiny bit of crypto might be okay, but this study suggests it's not going to be a game changer. What about the most diversified portfolio strategy? Did that show a different story?
Yes, it did. The most diversified portfolio strategy saw a much more significant improvement in profitability when crypto was added to the mix. And importantly, this improvement was often statistically significant, meaning it wasn't just due to random chance. They also found that as they increased the allowed allocation to crypto, the benefits of diversification became even more pronounced. For example, in the 70-30 portfolios, the Sharpe ratio often doubled compared to the all-stock portfolios.
Wow, a doubling in the Sharpe ratio. That's a pretty compelling argument for adding crypto.
It is. And while they did observe a small increase in risk, according to some metrics, the substantial gains in profitability suggest that for investors who prioritize diversification, cryptocurrencies could be a valuable addition to their portfolio.
So by really focusing on finding those assets that zig when others zag, they were able to unlock the potential of crypto without getting killed by its volatility. How much crypto were they actually holding in these MDP portfolios?
The MDP strategy allocated a significantly higher proportion of crypto compared to the global minimum variance approach. The typical allocation was around 8–10%, and this generally increased as the amount of crypto available in their investment universe went up. So they weren't afraid to put their money where their diversification strategy led them.
That makes sense. If you're serious about diversification, you can't just dip your toes in the water. You have to actually hold a meaningful amount of the diversifying asset. Now, what about the risk parity strategy? How did that one fare when they added crypto?
The risk parity strategy also saw significant improvements with the inclusion of cryptocurrencies. They observed both statistically and numerically significant increases in profitability as they went from the all-stock portfolio to those with 10%, 20%, and 30% crypto allocations.
So more crypto meant better returns in this case as well.
Yes, it did. As for risk, the findings were a bit mixed. Some measures of risk didn't show a statistically significant change, while others did increase slightly. But overall, the portfolios with crypto seemed to offer a better balance of risk and return compared to holding just stocks.
A better risk-return profile is always a good thing. So how much crypto was the risk parity strategy typically holding?
Similar to the most diversified portfolio strategy, the risk parity portfolios also increased their allocation to crypto as more became available. The typical allocation in the 70–30 mix was between 15 and 20%, which is a pretty substantial amount.
So it seems like both the most diversified portfolio and the risk parity strategies, which go beyond just minimizing risk, found real benefits in including crypto. Now, what about that simple, equally weighted approach? Did that also sing crypto's praises?
The equally weighted strategy did see a boost in profitability as the crypto allocation increased. But there's a big caveat here. It also came with a significant increase in risk.
So higher potential rewards, but also a much bumpier ride?
Exactly. Since equally weighted puts the same amount of money into each asset, as you add more volatile assets like crypto, the overall portfolio volatility naturally goes up. So while there was a potential for some big wins, there's also a much higher chance of experiencing some pretty painful losses.
So maybe not the best strategy for the faint of heart. It seems like the main takeaway from this study is that just throwing crypto into your portfolio willy-nilly isn't necessarily a winning strategy.
You got it. The real key is to be strategic about it. The study showed that in many cases, including cryptocurrencies in a thoughtful way, particularly using diversification-focused strategies, can lead to a better risk-return profile compared to sticking with traditional stocks alone.
And this idea that crypto can be a valuable diversifier is supported by other research that shows cryptocurrencies have historically had a low correlation with traditional assets. However, as we always say, it's crucial to understand your own risk tolerance and investment goals before making any big changes to your portfolio.
Absolutely. Risk tolerance is key. What might be a great opportunity for one investor could be a recipe for disaster for another. That's why it's so important to do your research and understand the potential downsides as well as the upsides.
So for all you listeners out there, this deep dive has hopefully given you a clearer picture of the potential impact of adding crypto to your portfolio. Now, here's a final thought for you to chew on. How might you apply these insights to your own investment strategy? Are you comfortable with the added risk that crypto brings to the table? Or do you prefer a more conservative approach?
These are the questions every investor needs to grapple with. And as the world of finance continues to evolve, it's more important than ever to stay informed and explore different approaches to building a portfolio that meets your unique needs and goals.
Couldn't have said it better myself. That's all for this week's Deep Dive. We'll be back soon to explore another corner of the financial world. Until then, happy investing, everyone.